Okay, folks, it's 3:30. Okay, I'm going to start this class with a question that I'm going to start the next few classes with, so get used to it. How many of you are not in a group yet? Don't feel ashamed. Just put up your hands. How many of you are not in a group yet? Remember, you have no idea what I'm talking about. You're supposed to be in a group. How many of you are not in a group yet? Really? Everybody's in a group? Or you're not in a group? You're not in a group? In fact, keep your hands up. How many more people are not in a group? If you have a group of 4, there you go, right? You fix your problem. There's 2 people right there. I will be sending out the orphan lists for you to add your names on, and don't feel shy about doing it, right? Now I will make a pitch about how pathetic you are and how you need to be adopted. Ignore it and you will get adopted, right? But I will not force you on a group. Second, and this is, I want an honest answer. And for the moment, I don't expect a big positive response. How many of you have picked a company to value already? Okay, we're getting started, right? A few. Who did you pick? Sorry? Warner Brothers Discovery. No, who did you pick? Okay. I do notice that in the master list, names are starting to show up. I would like that list to be filled in the next couple of weeks. I'm giving you a lot of room to run. And don't be Hamlet. You've seen Hamlet, right? He can't make up his mind. The poor guy dies as a result. You know, don't go back and forth. Just pick a company. You can always change your mind. I'm okay with it. Yep. AMD. Okay. So make sure you enter the names in the master list. If nothing else, I want to see you. And don't worry about other people picking it. Just, oh my God, you picked NVIDIA. I was planning to do it. You can pick NVIDIA too. Because just because you both pick the same company doesn't mean you'll tell the same story and come up with the same value. So your next valuation of the week is going to be Tesla. The time is right. The time is always right for Tesla, but the time is particularly right because the stock, as you know, is down from the stratosphere down to 180, which is where I valued it in November of last year. My limit buy went into effect yesterday. So I'm a proud Tesla shareholder. God help me, it's a corporate teenager, of course, who knows what the next few days will deliver. But I'm going to put my valuation of the week. It's a little complicated, right? So again, it's actually set up as, I let you pick based on a pull down menu. What do you think Tesla is? Just a car company, a car plus an electric. So go with the menu, even though it might be insulting to you because you want to get into the numbers. For the moment, it's just too tricky a company to get your hands around, but at least you can make choices what kind of company it is. So I'd like to see that Google shared spreadsheet. For those of you who did the GameStop, thank you. I know it's, I think 50, 60 people did it, but I'd like Tesla to get to the hundreds. Now, especially since the MBA class started this morning, they're going to be kicking in as well. So let's get this crowd valuation of Tesla going. Okay. Any questions before we start? Okay, yes.
Do you think that you having your numbers bias at that point?
Of course it does. Of course it does. And early on, you're going to be intimidated enough to be close to my number. Here's what I hope the class will do, make you less intimidated by my stories. Because one of the things I'm going to tell you is I screw up all the time. My kids will tell you how much I screw up. And maybe by screwing up enough and letting you see how much I screw up, you'll get to a point of saying, this guy screws up all the time. Why am I listening to him? That's healthy. I'll tell you what, I can tell when the class is working when the numbers start to deviate from mine. Right now, a lot of GameStop numbers are very close to mine. That's human nature. Early on, you tend to kind of stay close to, that will change as you go through the class. So let it happen on its own organically. I'm not going to force you to give me a different number because that's silly. But you will get comfortable enough to disagree with me, and that is healthy. So today we're going to finish up that big picture of different ways of approaching valuation and start on the meat and potatoes of intrinsic valuation. And today's start of the class test is about the meat and potatoes part. So I'm going to jump ahead to something that we'll do later in the class and use it as my starting point. When you approach the value of a business, there are two ways you can value a business. So one of the constructs I like to use to explain why accounting is different from finance is what's called a financial balance sheet. Financial balance sheet, you break a company down into assets in place and growth assets, in terms of value. And then you look at the two ways you can raise money, borrowed money or your own money, debt and equity. There are two ways you can approach valuation. One is to stay equity focused. So let's play a game. Let's suppose I start a business. You guys are my equity investors. And you guys are my bankers. You lend me money. So let's start with the easy one. You lend me money. What's our arrangement? It's a contractual commitment. I make you interest payments, all specified up front, right? The interest rate is set, the principal is set. So debt is a contractual commitment. You guys gave me money, but what is my commitment to you? It's a residual commitment. You get what's left over, if there is any left over. So here's the first way to do valuation. I'm going to keep my eyes focused on you guys, on equity. I'm going to look at the cash flows I expect you to get as a residual cash flow, which will require making assumptions about what do my numbers look like, how much do I have to, it's cash flows after debt. And I'm going to discount those cash flows back at a cost of equity. See, what the heck is a cost of equity? Why did you guys invest in my equity? Because you felt sorry for me? I hope not, right? You invest in equity because you wanted to make a return, right? You know, the cost of equity is the number you had in your head as your required return. Now, do you see where the cost of equity is going to be a nightmare to estimate? We'll come back and talk about it. But if I take cash flows to equity, what you get as equity investors, and I discount it back at the cost of equity, and we'll have to talk about how to estimate it, what I get as a present value will be the value of equity in a company. In fact, until about 30 or 40 years ago, the only cash flow equity investors actually saw tangibly as a check in the mail was which cash flow? Dividends. The dividend discount model is a special case of an equity valuation model. We'll talk about more expansively looking at cash flows to equity, but I'm staying equity focused. You're saying, what are the ways that approach valuation? Did lenders get cash flows too? What are the cash flows you got from me as lenders? You got interest payments and principal payments. If I look at the collective cash flow both of you got out of the company, it's kind of counterintuitive, but think of the lenders as your partners in supplying capital. You both get cash flows. If I look at the collective cash flow, that's called the cash flow to the firm. The cash flow to the firm is the total cash flow before debt payments, because lenders are no longer viewed as being outsiders. And if I'm going to discount that collective cash flow, and this is critical, I can no longer use the cost of equity as my discount rate, right? I have to use a weighted average of what the cost of equity is and what the lenders demand, which let's call it the cost of debt. What's that weighted average called? I mean, you've taken finance classes, you probably have what's a weighted average of my cost of equity and my cost of debt? The weighted average cost of capital. If I take the collective cash flow and discount it back at the cost of capital, what I get as a present value is not the value of the equity, but the value of the entire business. You're saying which one's right? If you do it right, you should get the same value. The key is to stay consistent. In other words, you can't mix and match. So you ready? You know enough valuation now to make a judgment on what the right discount rate should be. It shows up in every acquisition. So to set this acquisition in perspective, I'm going to take you back to the 1970s. Company called Kennecott Copper. It's a copper mining company. It acquired a subsidiary called Peabody Coal mining subsidiary. In the 1970s, antitrust laws were very strictly enforced. So Kennecott was forced to divest itself of its coal mining subsidiary. It got $660 million from the divestiture, which came and sat on the company's balance sheet as cash. And this terrified the company's management. What's so terrifying about having a lot of cash on your balance sheet? What were they worried about? Inflation would be a sensible thing to worry about. They were more concerned about themselves. So what does having a lot of cash on your balance sheet make it? Makes you a target for a takeover, and they did not want to be the target for a takeover. What's the most sensible way to get rid of $660 million in cash that you don't have a use for? Give it back to the shareholders, right? That thought never even crossed their minds. What's the stupidest way to get rid of $660 million in cash? Do something quickly, spend the money. So here's what they did. They went to First Boston. At that time, the leading M&A bank on the street. And they said, we have $660 million to spend. Can you find us a target? This is like walking to Bloomingdale's with $5,000 in cash, waving it around, say, can you help me spend this money? I really need to spend it. But you'll be surrounded by salespeople working on commissions trying to get you to buy stuff, right? So guess what First Boston said? No problem. We'll find the perfect target for you. And they came back with the perfect target, which coincidentally, they could buy for exactly $660 million. Here's one of the first rules in acquisitions. The value of a target firm will magically inflate to remove all the cash from your balance sheet. Imagine, can you see why Apple should never be an acquirer? And First Boston, of course, backed it up with a valuation of the target firm is a company called Kennecott. I'm sorry, was a company called Carborundum. It was a abrasives making company. It makes sandpaper, metallic abrasives. They said it's a perfect target for you. We value the company at $450 million. I'm sorry, you're paying $660. We're valued at $800 million. You're getting a bargain because you're getting it at below value. So far, so good, right? The banker did their job. They found a target. They valued it. This is the valuation. I mean, for the moment, it looks like a whole host of numbers. I'll lead you through the valuation. Okay? This is the valuation that First Boston, leading M&A bank on the street, did on Carborundum. You ready? I'm going to lead you through the valuation, tell you what they did. And here's the only thing I want you to think about. Given how they computed cash flows, I want you to tell me what the right discount rate to apply on these cash flows is. So First Boston projected out revenues, subtracted out expenses, come up with operating income, subtracted interest expenses. This is key to come up with projected net income. Then they subtract reinvestment, debt payments to come up with cash flows. Now, I told you they subtracted interest expenses and subtracted debt payments, right? So hold on to that thought, because that's going to tell you a little bit about what kind of cash flow they've computed. So you ready? They've got cash flows that they've computed the way they did. There are four, in this case, I'm going to give you 6 different discount rates. Only one of them is the right answer. I want you to tell me which of these 6 discount rates you would use in discounting these cash flows. First, you can use the cost of equity, the cost of capital. So I already want you to think about, given how these cash flows are computed, whether you'd use cost of equity or cost of capital. That's the first choice. Second, whose cost of equity or cost of capital using? What do you mean? There's the acquiring company which comes up with the money, which in this case is Kennecott. There's the target company whose cash flows you've estimated, which is Carborundum. And there is this merged entity that will exist after you've done the acquisition, which is going to be somewhere in the middle. So let's start with the easy one. Given how cash flows were computed, should I use cost of equity or cost of capital, and tell me why? Yeah. That's it, right? If I subtract our debt payments, there's nothing to debate. These are cash flows left over after debt payments. They're cash flows. So it should be cost of equity. That was the easy part. Now I want somebody else to jump in and tell me whose cost of equity. This is the most screwed up number in all of M&A. Let's see if you screwed up the way most bankers do. right? Whose cost of equity? Want to try? The target company's cost of equity, which is actually absolutely right. But let me play devil's advocate. Who's spending the money? The acquiring company, right? This is the logic that a lot of bankers use for using the acquiring company's cost of equity. It's our money. Therefore, we should put our cost of equity. It should be the target company's cost of equity, and lay out why. When you did capital budgeting, you computed net present value for a project. You took the cash flows in the project and you discounted those cash flows back at a discount rate, right? You know what the rule in capital budgeting is? The discount rate for a project should reflect the risk in the cash flows in the project, not the risk of the company looking at the project. So if you're a really safe company looking at a risky project, you can't magically make the cost of equity low because you're a safe company. It should always be the target company's cost of equity, no matter what. There is no ifs and buts. There's no escape hatch. So we all agree it should be Carborundum's cost of equity, which in this case would have been 16.5%. You're saying, why was it so high? Remember, it's the late 70s. T-bond rate was 8, 9, 10%. Basically, you're pushing everything up. Now, I want you to guess what First Boston used as their discount rate. What's the worst possible choice you can make? Kennecott's cost of capital. That's exactly what they did. They used a 10.5% cost of capital. You're saying, what's the big deal? You take their cash flows, don't change a single assumption. You discount them back at 16.5% instead of 10.5%. Remember the 800 million they said was the value of the company becomes 450 million. You've effectively advised your client to pay $200 million more than the value of something because you screwed up and used the wrong discount rate. You see, they must have gotten into trouble, right? This actually became a Harvard case study. You know, when something becomes a Harvard case study, what follows? Like, it became a strategic case study. Strategic case studies, you have those, cash cows, dogs, pigs, animals wandering around, and you say, is this the right target for the company? And as an exhibit, this was included. They never thought this would become an issue. I couldn't care less about cash cows or dogs. I went right to this and say, is the valuation done right? It wasn't. And First Boston did not get into any trouble. In fact, the two guys who ran First Boston were called Bruce Wasserstein and Joe Perella. And if you remember, they founded Wasserstein Perella, who did what? Couldn't value $20 in a brown paper bag. And they made a lot more money. And finally, as punishment, Dressner bought Wasserstein Perella for $2.5 billion. There's no justice in this world. You can do incredibly stupid things and keep rising up the ranks. But what I'm trying to say is just because a big name is on a valuation, Goldman Sachs, KKR, don't assume that fundamental mistake. This isn't a mistake about did they use the right growth rate. This is a fundamental mismatching mistake that gets made. So this is something I want you to file away, right? People make really fundamental mistakes and they come from backgrounds we said they should know better. And I'll tell you, people said it's probably First Boston knew what they were doing. I don't think so. If you ever worked in an investment bank, everything's on a deadline. I want it by midnight tonight. Why? I don't know, midnight tonight. Two teams work, one on cash flows, one on discount rates. 11:57, they get together in the same room. They have 3 minutes before the deadline. Who's even asking, where do you get the discount rate? You basically put the cash flows and discount rates together. Mismatches happen because people are not stepping back and asking the right starting question. Okay. So let's go back to I think we were on page 10, and I was talking about intrinsic valuation and when it works best. So are there any questions about the big picture of intrinsic? There's lots of details we haven't done. Intrinsic valuation, you're looking at an asset, looking at its cash flows and risk and coming up with the value. But you are at the mercy of price not adjusting to value. So you need a long time horizon. And you need to really just care about cash flows, not what other people think about the stock. Let's move on to pricing. Okay? What is pricing? In pricing, you try to attach a number to a company based on what other people valuing similar companies are paying. It's how we buy houses, how we decide how much to pay for an apartment. It's human nature. It's how we, I mean, I was looking for opening day tickets to for the Yankees. And I missed that window to get it from Ticketmaster because you know how it works, right? You got to be on a phone like 16 hours, and I gave up and hung up to. How do I decide how much to pay? I went to StubHub and looked to see what other people were charging for tickets. And I can't do an intrinsic valuation of a seat. I've got to pay what based on what other people are paying. That's what pricing is. So in pricing, you've basically given up on the notion of intrinsic value. You say, I don't know what the intrinsic value is, but I know what other people are paying for similar things, so I'm going to focus on that number. And if you break pricing down, no matter how complex you make it, here are the three things you will see. First, you will see the price standardized. You know what I mean by that? You're comparing two buildings of different sizes. The bigger building is going to be priced higher. So what do real estate people do? They look at the price per square foot. In stock markets, you divide price by earnings, price by book value, enterprise value by EBITDA. A multiple is just a standardized price. So that's the first step. Second, you got to find other companies just like yours. Is that going to be easy, you think? If I asked you to price Microsoft, you're in trouble, right? How many companies are there out there like Microsoft? You know, other software companies, they're tiny relative to Microsoft. So there'll be a lot of hand waving. And he said, these 15 companies are just like mine. So you have standardized price, you have comparables. And if you're careful, you dot your I's and cross your T's. You control for differences between the company you're valuing and those companies. So AMD, who you're going to, already looking forward, who do you think is going to be your peer group? Who you're looking at? NVIDIA, Intel, basically you can go down the list, including Taiwan, but you can already see very diverse mix, right? Taiwan Semiconductor is actually making the chips for all of that, pretty much. NVIDIA doesn't make a single chip. Do you know that? Its entire chip production has been outsourced. They're chip designer. It's outsourced to Taiwan. So do you think you're exposed to China risk with NVIDIA? God, are you exposed to China risk? So as you compare across these companies, you're going to have to face issues like that. Do they make their own chips? Do they design their chips? Their margins are going to be very different as a consequence. So when you do pricing and you do it right, you find other companies that you say like yours, but then if you're careful, you have to control for differences. But let's say you do that. You come up with a pricing for your company. How do you make money in your pricing? Well, let's assume you come up with a pricing for AMD that's 15% higher than the current price. So based on what other semiconductor companies are priced at, it should be. So you buy a stock at the price, and then what do? Just like an intrinsic valuation, you wait for the price to correct. But here you have probably a better shot of correction because it's going to stick out like a sore thumb. So if every other semiconductor company is trading at 25 times earnings and AMD is trading at 18 times earnings, you're saying somebody will notice. See the advantage of pricing? You don't need as much of a time horizon. A much shorter time horizon, corrections happen quicker. You're still assuming corrections, but a very different kind of corrections. So here are the advantages of pricing. You're staying in sync with the market. The nature of pricing is you're riding with the crowd. So all its pluses and minuses. So you're not going to be the odd person out. No, so it's going to build in. And if you're a trader, that's how you make money. You want to stay in sync with the market. Second, the nature of pricing is there'll always be underpriced stocks. Remember with valuation, I said everything can be overvalued. That can never happen in pricing. And here's why. If I take 20 semiconductor companies and I compare the pricing across the companies, will I ever conclude that all 20 companies are overpriced? When I remember in my school district, the person who ran the district came out and we'd go to these meetings, the parents' meetings, and he got up and he said 97% of the kids in our school district are above average. It's a very strange statistic. So I put up my hand and say, what's the average? You either have some really dumb kids pulling the average down and everybody's above average. Maybe they're below zero, Or you just defined average to mean whatever it does. The nature of pricing is you're going to get half of stocks being underpriced. And that's good if your job is to pick stocks, right? If you're an equity mutual fund manager, you can't tell me that, hey, everything looks overpriced, I'm not buying anything. Your job is to find stocks. So the nature of pricing is you'll find something cheap or expensive, no matter what the pricing looks like. And pricing, by its nature, is less work. You find comparables, you spread them multiple, and at least on the surface, you're saying, I'm not making the kinds of assumptions you had to make in discounted cash flow valuation. Most of what you see out there on Wall Street is pricing. And some of it is driven by these reasons. But there are disadvantages. The first is that when you tell me something is cheap on a pricing basis, if you tell me AMD is the cheapest semiconductor stock based on pricing, remember, you're making a very specific statement. Relative to other semiconductor stocks, it looks cheap. Is it possible that all of the semiconductor stocks are actually overpriced, overvalued? Yeah. But when you do pricing, all you're finding is the least expensive of these stocks. So sometimes with pricing, if the entire sector collapses, your only consolation price is your stock will be down only 65%. You think, how is that a constant? Because everybody else is down 80%. That might sound like a terrible thing, but remember that many portfolio managers are judged based on relative performance. You're a great portfolio manager if you're down 20% in a year where everybody else is down 35%. And because portfolio managers are judged against other portfolio managers, there is this incentive to do pricing even if this is true. So when you think about pricing, be open about its pluses and minuses. It's easier to do. You're always going to be in the market. But it also means that if there's a bubble, you're going to get caught up in the bubble. You're going to lose money like everybody else because you are part of the crowd. So let's think about when pricing works best, what kinds of investors. And you go down, think about people out there on Wall Street, think about, hey, will they use pricing or intrinsic valuation? First, pricing works best when you have a large number of similar assets that are priced out there. It works in real estate. Lots of buildings out there being bought and sold. It works with stocks. But if I gave you something that is difficult to find, for instance, if the collectibles and fine art, Picasso's, if the way you put a number on them is you go to Sotheby's, and Sotheby's hires an expert who says this Picasso is worth 150 million, and they charge a hefty price, 4% of the price, 6%. You're saying, why would I do that? Why do you need an expert in Sotheby's to do that when you're doing a Picasso, when you don't do it with real estate and stocks? Yeah.
There are no cash flows and you can't make money.
Because there aren't that many Picassos that get sold every year, right? The last Picasso might have been sold 4 years ago, or 6 years ago, 8 years ago. You can say, why can't I compare a Picasso to a Monet? It doesn't work that way. I mean, for whatever reason, each has its own bucket. And because you can't find enough traded stuff out there on which you can get a price, you're going to have to give up on pricing when you're pricing something truly unique. That's why you pay 6% to the appraiser to come up with that number. Now, and it tends to work best for what kinds of investors? First, if you have a shorter time horizon, pricing probably works better for you than intrinsic valuation because the market doesn't need as much time to correct its mistakes. Second, if you're judged against a benchmark, and that's a big deal, pricing is going to be a preferred option because you're not judged against an absolute number. Did you make 8%? You're judged against what did other growth managers do? What did other value managers do? And finally, if you're an investor who can take advantage of mispricing in both directions, you have an advantage. You know what I mean by that? If you're underpriced, you can buy. And most mutual funds can only buy. They're long only. But a hedge fund, if it's a true hedge fund, can buy, but it can also sell short. So if you do pricing and you buy underpriced and you sell overpriced, if you're right about the pricing, it doesn't matter whether you're wrong about the overall level, because as long as you get the correction towards a fair value, you could be wrong about the entire market, but you're still going to walk away with profits because your underpricing is going to outperform your overpriced stock. Basically, you're making money in both directions. There's a reason why pricing is so deeply embedded in investing is because for many investors, it makes more sense. You have 6-month time horizons, you judge against other portfolio managers. Nobody at Fidelity. Let me take that back. Some people at Fidelity might use intrinsic valuation, but most Fidelity fund managers are doing pricing. And I understand it because given the incentive structure in investing, that's exactly what you should expect to see. And finally, I mean, this is, I think, a point that was raised earlier. There are some things that cannot be priced. About 5 years ago, in response to all these questions I was getting about, do you think Bitcoin is undervalued? I finally said, look, let's step back from the brink here. Let's talk about whether something can be priced or valued. And I broke everything out there into 4 buckets. It can be an asset. An asset is something that generates cash flows. It could be a business, a stock, a bond. These are assets. You can have a commodity. What's the essence of a commodity? A commodity is used to make something. Examples would be iron ore, oil. So basically, it's used to make a product. It could be a currency. Currencies are just scaling mechanisms, right? Or it can be a collectible. Why do you value a collectible? Because it's scarce and you think it'll stay scarce. So stocks are assets. They can be both valued and priced. Iron ore and oil and other commodities generally will be priced. There's demand and supply. You could probably create a macro model of production of oil and consumption of oil, and people do terribly noisy models and try to value commodity based on demand and supply. But it's tough to do. Most people price commodities. Currencies can only be priced. In fact, what do we call a currency pricing? An exchange rate. You can't value a currency. And finally, a collectible can only be priced. You have a Mickey Mantle rookie card, great collectible, but don't look for a discounted cash flow valuation. It's priced. Right? That Mark McGuire rookie card you got in the late 90s and paid the sun and the moon for? What's that all about? See? That Mark McGuire card's lost all its pricing. Why? Because he found he may use steroids. The Aerod cards are down in pricing as well. The nature of pricing is entirely based on perception. Finally, let's talk this little tangent that I said I would get to at some point in the class. Sometimes, rather than value companies, you value assets. You're saying, why would I have to do it? No, one is if you have to do a liquidation valuation of a company, because there you're looking to see what can I sell different assets for. It could be because you want to do it for accounting reasons. Accountants have to put numbers on assets. You have to value individual assets. Or if you're an activist investor trying to buy a company, you're valuing the individual assets because you plan to break up the company and sell off the pieces. Nelson Peltz is targeting Disney because he wants Disney to sell ESPN. In fact, he has big plans: sell ESPN, get rid of other businesses, go back to your core business of making movies. Even Disney Plus, he thinks, should be spun off as a standalone to compete against Netflix. Not a bad idea if you think about it, but to make that judgment, you got to value the pieces. So there are times, so rather than value a company, you might want to value the pieces of a company, and you can either value it or price it. What's the difference? If you ask me to value ESPN, I've got to project the cash flows from ESPN, discount it back at a risk adjust, come up with the value of ESPN. If you want me to price ESPN, which is just one piece of Disney, then I look at what they have as revenues, look at the multiple of revenues that other companies like ESPN trade at, which will be tough to do, and I can price each part. Again, when people ask why, so often the reason I've introduced this page is I used to have intrinsic valuation and pricing. And somebody say, what about some of the parts valuation? What about liquidation? And my point is they're not different approaches to valuation. They're just applying either intrinsic valuation or pricing in a different context. So you don't need special rules or new models for some of the parts valuation. You have to make your decision, though, is are you going to value them or price them? So I think you have enough of an overview of the different choices. And it is going to sound incredibly unfair, but go along with me. Given what I've described to you about intrinsic or discounted cash flow valuation, and pricing. And I gave you the advantages and disadvantages. If you had to pick, and I'm not going to pick for you because the choice is going to vary depending on your time horizon, where you think you're going to be using these numbers, pick what you think it resonates most with you as somebody looking at a company. You think you might want to do pricing or you might want to do valuation. The reason I'm going to do that is at the end of this class, I'm going to ask you exactly the same question. You know what I want to see? Many of you have never actually fully done an intrinsic valuation of a company. So in the abstract, everybody wants to be Warren Buffett. Everybody wants to do valuation. It's amazing what one experience with valuation can do in terms of changing your perspective on what exactly is involved. So I'm completely open to where you will end up. So for the moment, just pick one. And then the 15th week, when I ask you the question, I'm going to ask you how many of you have changed your minds and tell me why. So some of you might pick valuation as your intrinsic valuation as your preferred choice now, but you might switch to pricing. Some of you might pick pricing and switch to intrinsic valuation. Or some of you might end this class saying, what the hell am I even doing trying to put a number on a company? I'm just going to buy the Vanguard 500 index fund and go back to living the rest of my life, which is a completely healthy conclusion. So for the moment, just pick what you think fits where you are now, and then we'll come back and examine this at the end of the class. One final piece, as I said, there's the third way you can put a number, and this is the one part of this class which is probably new and different that you would not have seen 30 or 40 years ago. In the early 1970s in finance, we developed option pricing models, Black-Scholes, binomial. You might have seen this in the other classes, mostly to price or value options, listed options, warrants in companies, conversion options in bonds. But there are, the nature of an option, what makes options different from every other asset is you get a right to do something. So let's see how much basic option pricing you remember. There are two types of options, call options and put options, right? What does a call option give you the right to do? Complete the sentence. Buy something at a fixed price. Without the fixed price, it's not an option. So that's the first thing to remember. The right to buy something with no price specified is not an option at all. The right to buy has to come at a fixed price. Whatever, it could be a building at a fixed price. So call options give you the right to buy something at a fixed price. And on a put option, you get the right to sell at a fixed price. Those two words, right and fixed price, play off in what are called payoff diagrams. I don't know whether you remember what option pricing payoff diagrams look like, but they are unique in terms of the kink you see in the cash flows around that strike price. The strike price is the price you've agreed to. And here's what the kink is. Because you have the right to buy, if let's say a stock at a fixed price, you will use that right only if the stock price is. So if I gave you the right to buy Tesla at 250, and I give you 2 weeks on that call option, how much would you pay for that call option? Tiny amount, right? The stock's at 183. There's the right to buy at 150. You say, I'll pay $35, $40, $45 for it because things can still move. So the strike price becomes the kink. Above it, you get upside with a call option. Below it, you get upside with a put option because you get a right to sell. It's that kink in the payoff diagram that makes options options. And to me, this is why options have to be treated differently than every other asset out there. I'll tell you how it's going to play out. We talked about risk in the context of discounted cash flow valuation, right? In a traditional asset, when I increase the risk of the asset, what will happen to the value of the asset? It'll go down, right? Risky asset. With an option, and I want you to start thinking about why this is true. When I increase the risk of the underlying asset, the value of an option will go up. It's almost magical. It turns everything we know in asset valuation on its head, saying risk is good for you. So what is it about options that makes risk your ally? Let me ask you a question. When was the last time you complained about upside risk? So that NVIDIA stock you bought 2 years ago, you're very upset, right? It's been so volatile. It went from 200 to 600. Not at all. Nobody ever says, oh my God, there's so much upside risk here. I can't deal with it. The only risk we worry about is downside risk. And what have I done with options? If you look at the payoff diagram, I've said I'm going to cap your risk. Risk becomes your ally because of the payoff diagram. Now, by itself, you might say, well, why is it going to play out in a class like this, which is not an options class? And here's why. If you are thinking about direct examples of options, you could do call options on the CBOE. You can look at warrants and convertibles. Clearly, option pricing I'm not going to deal with any of those. That's not the context of this class. But there are valuations of businesses where option pricing can actually help you understand what drives the value of a business. I'll give you a few examples. When you have equity in a deeply troubled company, let me be very specific about what makes it deeply troubled. It's losing money. It's been losing money for a long time. There's no light at the end of the tunnel, and it has a lot of debt. It's like a match made in hell, right? You're losing money, you have a lot of debt. What are you concerned might happen? The company might go bankrupt. But equity, these companies still trades, right? Equity in Bed Bath and Beyond might still be traded for all I know. The company is a basket case, no light at the end of the tunnel. You're saying, why would I buy equity in a deeply troubled company? For the same reasons you buy deep out of the money options. You're saying, what's a deep out of the money option? I was just checking this morning. There are call options on Tesla expiring in 6 weeks with strike prices of 225 and 250, which means for you to make money on these, the stock prices go from 183 to 250. What's the chance? Small, but I think the 225 options were trading at $1.50. Are the people buying these options stupid? No, they're making a bet. The bet is, I'll pay that. And if the stock moves to 250, the $1.50 will become $25. I'll get on Twitter and tell people how rich I got. Big upside payoff, but you're buying it for its optionality. Second, if you think about an oil company, the value of an oil company comes from two places. One is the oil it gets out of its existing reserves that it sells in the market and keeps the difference. So when oil prices go up, those reserves are obviously going to be more valuable because the value of the oil is going to be higher. But you also have undeveloped reserves. Those are reserves that you have the right to develop. Already you see a word shop, right to develop. And you get to decide when to develop them. And when will the oil company develop those undeveloped reserves? Think in option terms. What's the contingency that they're looking for? What's got to be true about the oil price? It's got to be higher than the cost of developing the reserves. It's an option. Here's how it manifests itself. I don't know whether you remember, but in March of 2020, oil prices plummeted. So at the peak of the COVID shutdown, they were down to $30 a barrel. In fact, there was a day where Brent crude in the US had a price of minus $32. What? The refineries were all filled. I mean, basically, there was no storage capacities. People couldn't even buy. So the oil price had dropped to $25, $30. You know what? How many oil companies have viable reserves at $25 to $30? Almost none. Aramco might be the only company that can make money at a $25 to $30 oil price. So if you looked at the $25 to $30 oil price, the question is, why is ExxonMobil trading at above zero? Why? And the answer is very simple. People were buying the companies, not based on the oil price now, but on the expectation that oil prices are volatile. They were buying an option. That optionality decreases, the oil price goes to 80, 100, 120. But think of oil price, they swing back and forth. You're really talking about the optionality in undeveloped reserves. We'll actually come up with a way of valuing undeveloped reserves as options using that variance in oil prices. Let's say you own a patent as a company. What does a patent give you the right to do? What does a patent give you the right to do? First, make it, right? But you have the right to make the product that comes as a patent. You don't have to. You see the optionality here? If I gave you the patent for some new, this morning I got an email from somebody saying, we've developed this great new AI technology. It'll cost you $100,000 a piece to make each unit. So right now it's not viable. It's an out of the money option, but it's at the cutting edge. And IBM might pay a large amount for that patent, even though it's not viable today because there's optionality. The advantage of bringing options into the discussion is now we can talk about these things. And I'll give you one final example. Last decade was a decade of platform companies, right? You know what I mean by that? They built big platforms, lots of people on the platform. Even though nobody was paying them any money, the platform was big. There was an optionality argument used for platforms, which is, even though I'm not making any money now, I have 100 million people on this platform. It could be worth a lot, which is, of course, true. So pay me. I remember in 2019 and 20, listening to the VCs online. One of them was a person I knew. He said, look, we don't make money. We don't even know how to make money. But there were a lot of people using Lime bikes. Remember, you could use the app? And he said, the platform should be worth a lot, right? And I said, not necessarily. What's the value of a platform? There's optionality. What does your optionality come from? What you can do with people on the platform. With Facebook, I can talk about optionality. Why? Because you have 3 billion people on the platform who spend an hour every day. Maybe I can sell them stuff as a retailer. Maybe I can do ads. Maybe I can do news stories. Maybe I can do entertainment. Optionality. Twitter, not so much. Why? Because people don't spend a lot of time. They come and they go, but they don't spend 3 hours unless you're a crazed person and you stay on Twitter for 3 hours, in which case you will become crazed, even if you weren't crazed when you started the process. The platform for Twitter is going to be worth less than the platform. So I asked this guy, what do you think this platform, why do you think this platform? He said, we're learning a lot about people. Slide. I said, what are you learning? He said, we learn where they get the bike. We learn where they drop it off. So I said, basically, you know their location. Check your iPhone to see how many people know your location right now. It's a kind of, I checked yesterday, 27 different apps know exactly where I am. When I don't know where I am, I just check the app. So where am I? Yelp will tell me, you are right here, right next to this restaurant. The reality is location data is completely worthless. There's optionality. So when we talk about optionality, we talk about why some platforms have big option value and others don't. And that's the advantage of doing this, is you're no longer just throwing numbers around saying it should be worth a lot. So here's the biggest advantage of option, bringing an option pricing into valuation. It'll allow us to value things that they otherwise would have given up on. And second, it's going to give us insights into what drives the value of these option-like assets, why some platforms are worth more than others. So as we get to the option section towards the end of the class, I'll use option pricing models, but I want you to also think about the intuition. What does it tell me about optionality in general? In terms of disadvantages, much of option pricing, we look at actual models, was designed to value short-term options on listed stocks. You're saying, so what? A patent is an option, right? But the underlying asset is the product that will come out of the patent and the cash flows on it. It's not traded. Many of the assumptions we make in option pricing models don't really work with what are called real options. We're stretching them to the limit and breaking them. So I'd be much more cautious of the numbers I get with an option pricing model. I'll give you a value of a patent. I'll actually try to value a drug patent, for instance. But at the end, I'm also going to say, I feel much more uncertain about this than valuing a call option on IBM, a traded stock listed option. So it's as much for what you learn about this process here. One other thing about option pricing is there's a heck of a lot of double counting that comes about because of this options terminology. And what I mean by that is people will value a pharmaceutical company with a valuable patent for a new drug. They'll project out higher revenues and margins in the future because they have this patent. They'll come up with a value. And then they'll value the drug as a patent fully and add it on top of the value. That's double counting. Because if you counted the patent in your revenues and your growth rate and your cash flows, you can't be valuing it as a patent and adding it on. But there is this problem of double counting once you've opened the door. I think that's so. In summary, I mean, when people talk about there being hundreds of different ways you can value things, that's not true. Take those valuation models out there. Is it an intrinsic valuation, a pricing, or an option pricing? Everything has to fall into one of these three buckets, no matter how it's framed. Any questions about the big picture of the different ways in which you can put a number on an asset? Okay. So let's start on this packet, and this packet is going to take us through the next 13 sessions. So selection note packet 1, if you didn't bring it with you, not a big deal. But What we're going to do over these sessions is lay the foundations and try out intrinsic valuation. So let's step back. Let's think about what intrinsic value is over. The essence of intrinsic value is you're saying the value of an asset is the present value of the expected cash flows in the asset. That's intrinsic value in a nutshell. Okay? Of course, in practice, discounted cash flow valuation and intrinsic valuation are viewed as interchangeable. But discounted cash flow valuation is not the only way to do intrinsic value. It's my preferred way, but I can see other ways in which you can put an intrinsic value. The key is you're staying with the asset, you're valuing it based on its business model and its cash flows, rather than by looking at what other people are paying for similar things. So today's class is going to be about intrinsic valuation 101. So let's set up the process. I said the value of an asset is the present value of the expected cash flows in the asset. The most conventional way to do discounted cash flow valuation is to first project out expected cash flows. Notice, not conservative cash flows, but expected cash flows, and discount those expected cash flows at a risk-adjusted discount rate. The way we teach valuation in classes, the way we look at it in books. But there's another way in which you can do discounted cash flow valuation that's more uncommon, but still okay. Instead of using expected cash flows, you can come up with what are called certainty equivalent cash flows. I'll give you an example. Have you ever watched the Howie Mandel show where, you let's make a deal? Here's how it goes. So if you've never watched the show, it's a very simple show. Howie stands up there with two suitcases. One has $1 million. How you fit $1 million into a suitcase, don't ask me, but presumably it's in there. The other is nothing. You ready? You're a contestant. You're called up. So you have a 50-50 chance, 50% chance of making $1 million, 50% chance of making nothing. And Howie offers you guaranteed cash to walk away from the deal. Now somebody's saying, this is easy. I'm going to demand $500,000. Will you? Because it's uncertain, right? You could get zero. So what ends up happening is he'll offer $350,000, you get a little hemming and on, $400,000, you take the $400,000. That's a certainty equivalent cash flow. You're taking less than the expected value. Why? Because you're risk averse. It's not irrational. It's in fact completely rational. How do you do this in a discounted cash flow valuation? If you think of the expected cash flows in a Coca-Cola, there are bad outcomes and good outcomes. What if I could give you a cash flow that's guaranteed instead of that expected cash flow? Just like in the Howie Mandel case, if the expected cash flow next year is $5, you might say, look, if you give me $4, I'm okay with it. A certainty equivalent cash flow is a cash flow you will take instead of an uncertain cash flow. If you can do that, and your cash flows are certainty equivalents, you don't have to adjust the discount rate. In fact, what should the discount rate be if your cash flows are already certainty equivalent cash flows? Just the risk-free rate. In practice, I've seen almost no one do this right, but you see close variants of this if you watch value investors like Warren Buffett. Warren Buffett is actually very proud of saying that he doesn't use betas and he doesn't use a risk-adjusted discount rate. In fact, there's probably Buffett saying that you can find that says he uses the risk-free rate as his discount rate, which gives me problems because those people show up in my class and say, Warren Buffett uses the risk-free rate. How come you're using a risk-adjusted rate? They should actually look at what he has in his numerator. Old-time value investors, when they project cash flows, don't project expected cash flows. They project cash flows they can count on. What does that mean? They count only those cash flows which are in a sense almost guaranteed. So if there's some uncertainty and you don't think you can make it, they don't count it. So in effect, what are they doing? They're doing a kind of half-assed certainty equivalent cash flow. And because they've done it, they can end up using a risk-free rate as a discount rate. So next time somebody asks you, where are you learning about these betas and costs of equity and capital? Warren Buffett uses a risk-free rate. Well, guess what? If you're willing to adjust the cash flows to make them certainty equivalent, you too can use a risk-free rate as well. But then ask them, how would you come up with certainty equivalent cash flows for an NVIDIA? And you have a nightmare just as much as you have a nightmare in estimating discount rates. So let's use this to kind of build on basic intrinsic valuation. It's intrinsic valuation 101. Okay, you got the equation up there. Value of an asset is the present value of the expected cash flows. Now, if tomorrow when I post my Tesla valuation, I will get a lot of reactions, some not that nice. And one of the things that I will routinely get critiqued for when I do a valuation is that I'm a theorist. I've got to laugh because I know how little theory there is. This is the theory in my class, that equation. That is the whole class. This entire class is about finessing the expected cash flows and getting the risk-adjusted discount rate. But it's actually going to give me a vehicle to talk about what it is that drives value. So I want somebody to be my guinea pig, somebody who's never done valuation. Don't worry, I'll make you look really good when this is all done. You've done valuation before? Only, is there anybody who's never done valuation? I'm going to show you actually know intrinsic valuation already. You just don't know it yet. Anybody want to try? I don't want too far in the back because it's too much work for me. Okay, you're willing. So here's what we're going to do. I have an envelope. Let me make sure it's empty. I have an envelope. Nothing in there. Sleeves rolled up. So I'm not David Copperfield, no magic tricks. I have a $20 bill. Okay. I'm going to put in the envelope. To close it up. How much should you pay for this envelope? Don't think too long. It'll get you into trouble. Go. The answer is 20, which is the answer I almost always get. So let me follow up. If you pay $20 for an envelope with $20, what do you get out of this transaction? You actually get an envelope, which I stole from upstairs. And you can see it's very sloppy. I've written things on it so you can't mail stuff. So first rule in intrinsic valuation, if you know the value of something, don't start your bidding at that number. So let me give you another shot. $20 in the envelope. How much should you pay? 15. You have no future as a banker because bankers always have trouble. It should be higher or lower. It should be lower if you want to get a good deal. So 15, right? Or start with 1. Who knows what kind of disease I have? Maybe I can't read numbers, right? But this is a really simple asset to value. And you're saying, but isn't it always true? I'm going to try some. Anybody from India here in the audience? No Indians? What is this? No, nobody from India, right? So I'm going to try this. Somebody put their hand up. Who is it? Okay. I'm going to put a 500 rupee note into this. Same experiment. How much should you pay for this? Actually, you shouldn't even pay. Look at the year on that 500 rupee note. Do you see what it says? 2008. What happened in 2016? If you're from India, what happened in 2016? This is like toilet paper. It's not even very good toilet paper. This is something to remember about fiat currencies, right? The value of a fiat currency comes from its backing. Otherwise, just paper that you can't use. So the reason you value the $20 bill at $20 is there is this implicit trust in the currency and a government. It's something I want you to hold on to because it's something that drives fiat currencies. In fact, the last I won't even try on you. I have here $100 trillion. I'm not kidding. What does it say? $100 trillion. This is big, right? How much should you pay for this? That's Zimbabwean $100 trillion. This was after, this is a real note. It came after they'd had so much inflation that to pay for things, you had to pay in trillions of dollars. Right? But let's go back to US dollars and keep things about this. So $20, everybody agreed that if I open this up for an auction, we'll probably end up around $20. So let's say we've now priced this at $20 or valued at $20. Now I'm going to add things to it. And I want you to tell me, so now we're at $20. I'm going to add things and I want you to tell me whether it might affect how much you pay for it. Can you read to the class what this says? Control. I am now adding $20 to the envelope. So now you have $20 plus control. How much should you pay for this envelope now? You started at 20. I've added control. I told you I had no future as a banker. This cements it. You know why I use the word control, right? If any of you work at a bank and you're doing an acquisition, what happens? They add 20% to it. I'm not kidding. They value target company. And in fact, I tried this with a bunch of Goldman Sachs bankers about 7 years ago. And one of the Goldman Sachs bankers decides he's going to be clever. He offers me $25. You know what I did? I sold him the envelope. And think of what you got. You got $5 for a 3x5 card that cost me absolutely nothing. I stole it from upstairs as well. You see where this is going, right? So I'm going to add more interesting, valuable stuff. What does it say? Synergy. Okay, let's put that in, right? In fact, well, since we're going with this, any marketing people here? What does this say? Brand name. Let's throw that in there too. Oh, since we're in 2024, what does this say? AI. Let's throw that in there as well. What about ESG, sustainability, every other buzzword floating around this damn building? Let's stuff it all in there. I call these weapons of mass distraction because they show up after you value the company. You value a company and somebody wants to come up with a higher number. They start throwing these weapons at you. What about AI? What about brand name? And if they get truly desperate, they throw the word strategic, right? Because then clearly the numbers don't fly. About 10 years ago, you could throw in China. That always put another zero on your values, China. Now you cross it out, put India. What they share in common, 1 billion people, blows people's minds. I mean, look at how many consumers I can sell it to. But the bottom line is still $20. All of these are 3x5 cards. I made them up this morning. Cost me nothing to make. Now, let me be very clear. And this is, I think, going to be the first proposition I want to add on intrinsic value. Now, what the happened here? I call it the IT proposition. Let me state it. It's going to sound absurd, but hang it there. Here's what the IT proposition says. If it does not affect the expected cash flows and it does not affect risk, it cannot affect value. You think, what the heck is it? Control, brand name, synergy. In fact, let's step back from the banking laziness of attaching premiums to these words. What is the true value of control? You want to try, what's the true value of controlling a company? When you control a company, what do? You run the company instead of the existing people, right? If you think that's a kind of a cynical view of thinking about control, but the value of control is you run the company instead of the existing management. And if you think you can run the company better than the existing management, here's what you will get: a higher value with you running it than with the existing management running it. We will value control in this class. The way we'll value it is value the company twice. Once with existing management, let's call it the status quo, and once with you running the company, in which case I want specifics. What will you change about the company? And if you think you can run the company better, I'm going to get a higher value for your company than the status quo. That difference is the value of control. Do you see the implication of this? If you have a company that you think is already perfectly managed and perfectly run, let's say you think NVIDIA is just amazing, that it's run so close to perfectly that if you come in, you can't change much. What's the value of control in NVIDIA? Zero. Whereas on the other hand, you have a company that's so badly managed and badly run that if you can chew gum and walk at the same time, you're ahead of the existing management, you're going to get a huge value for control. What's the value of a brand name? It's kind of fuzzy. You guys will walk into a CVS or walk into CVS, walk down the painkiller aisle. Get to the aspirin section. There's still an aspirin section. Or the Sudafed section. There's still a allergy section. You will see Bayer aspirin. I checked the price this morning. $2.79 for 100 pills. And right next to it, you'll see CVS aspirin. $1.59. Check the ingredients in case you're suspicious. Aspirin's been off patent like 100 years. It's exactly the same. Then ask yourself how often you reach for the brand name, the Bayer, the Sudafed, even though it's exactly the same. That is brand name power. It allows you to charge a higher price for exactly the same product. So you know where it shows up? It shows up as higher margins, higher earnings, higher cash flows. It shows up in the cash flows. There is no brand name premium. And I'll value Coca-Cola later in this class. There'll be no premium. It'll be in the numbers already. What's the value of AI? It's a big buzzword right now. Everybody's wanting the. What's the value of AI to NVIDIA? It's a market that's growing. They control the chip. They know more about these chips. There it's tangible, right? What's the value of AI? Somebody from Pepsi emailed me and said, what will AI do for us? I said, nothing. What the heck will AI do to Pepsi? It's like big data for Pepsi, right? You collect big data. What's the big data going to tell you? The value of AI for 95% of companies is either going to be zero or negative. You know why negative, right? If everybody's doing it, you're going to spend money on AI. There'll be no benefits, but you have to do it because everybody else is doing it. Kroger mentioned AI in its last earnings call 13 times. What AI are you doing? I mean, when I go into a grocery store, what exactly are you doing to me? I mean, it's terrifying to think about it actually working. But you can already see it forces you to ask tangible questions. That's the proposition. It's a proposition I pull out all of the time. For those of you familiar, I've taken ESG. I mean, I can't think of a single good thing to say about this concept. I've tried, nothing there. But if you go back and look, my first 2009 post on ESG asked the question because I heard Larry Fink say ESG is good for value. And I said, okay. Proposition, if it's good for value, it's got to show up somewhere, right? Cash flows, growth rate, risk. I went through and said, nothing there, nothing there, nothing there. Either Larry Fink has no idea what he's talking about, which is entirely possible. This is a fixed income guy who, through the accident of history, happens to be now managing $11 trillion of other people's money in equities. Or he's just a feckless knave, which is entirely possible. Which is, he knows it has no effect on value, but he's making too much money on ESG to say so. When you see buzzwords come at you, this will make you a very unpleasant person to have in class and other classes, but that's not my problem. When somebody says sustainability is good for value, stop them right there and say, can you explain how? I've tried. In fact, I talked to 50 CSOs, chiefs. There's actually a person called a chief sustainability officer at 50 of the S&P 500 companies. I didn't even know there was a job that existed like that. So they said, can you come and talk to them? I said, absolutely. I just want to know what they do. So that was my first question. What do you guys do? Are you like the Dalai Lama? Do you walk around and say, I can see, long term? Are you like Jiminy Cricket? You said, you've seen, Pinocchio movies, you stand, you basically are the conch of the company. I said, what do you guys do? They didn't even know what they did. It's kind of a scary thought. And I said, if you don't know what you do, how the heck is there any value to this other than it sounds good? I can understand sustaining the planet, but sustaining companies, I just still don't get it because I don't see the proposition. You see, but you're so focused on money. Next time you get a paycheck, maybe you'd like it in qualitative dollars rather than quantitative dollars. Guess what? Ultimately, it's got to be cash in, cash out. And you got to show me a pathway. I'm willing to be imaginative and creative, but tell me where. The second proposition is a don't be a wuss proposition. Let me explain what I mean by that. Okay? A lot of you, as you sit down to value companies, will find yourself having to make estimates, and you're going to get uncomfortable. And then you're going to want to change companies. I predict this will happen. Like 3 weeks in, so I picked NVIDIA, but it seems to be really difficult to value. I'm going to go back to value Coca-Cola. Come on. If you really want to value Coca-Cola, why bother taking this class? I mean, you could mechanize it. It's easy to do. So when you face that uncertainty, hang in there, make your best estimates. And remember, everybody else looking at this company faces exactly the same challenges. You're not alone. The third proposition, I named after my daughter, especially when he was 16, 17. One of her favorite expressions with me, especially, was, Dad, duh. The amount of contempt that oozes out of this room. duh was mind-boggling. So we'd sit down for dinner, we'd talk about, but some topic would come up for conversation. I thought I had something to contribute. I'd get ready to contribute. And she'd look at me and say, Dad, duh. And I stopped talking for like 3 years until I finally said, okay, I think I can contribute again. So here's the duh proposition. It's reserved for those cases where, and I get this several times a week, where people say, I'm trying to value a company. I'm projecting the cash flows, and the cash flows are negative forever. What kind of company is that? A company with a horrifically bad business model. I'll give you an example. You guys remember MoviePass? I remember listening to this. Who would be stupid enough to think this was a good business idea? You know how MoviePass worked? It's like 2000. You paid $9.99 a month for MoviePass, and you could go to as many movies as you wanted in regular movie theaters, and MoviePass would pick up the cost of your movies. How much does it cost to go to a movie in New York now? Like $23 to just get in? $9.99, as many movies. So I said, who would be stupid enough? And I found out because the CEO of the company came on CNBC to explain the basis for the company. And I discovered who would be stupid enough to think this is a good idea. And this is how he justifies it. He says, the average cost of a movie ticket in the US is $7.50. The average American goes to one movie a month. And we're charging $9.99. We'll make $2.40. What's he missing with the average thing here? Yeah, go ahead. There's a selection bias, right? The people who bought MoviePass were people like my son, who's an entertainment guy who goes to like 25 movies a year. You go to 25 movies a year, and let's say the movie ticket costs $10, and he lives in LA, probably costs $20. You're getting, what, $500 worth of movies for $9.99? And he said, a lot of people are buying, of course, that's like Starbucks saying you can drink as many lattes as you want with a $10 monthly pass. Some of you will be getting the $10 monthly pass. You right now drink 2 Starbucks a day. You go to 6 Starbucks a day. So the duh proposition is reserved for companies with negative cash flows for us. And here's how the emails go. I have a company with negative cash flows forever. How much should I pay for this company? You feel like slapping the person around the face. Say, wake up. You have negative cash flows forever. They should be paying you, not the other way around. So let's get that out of the way. You sit down to value a company, see negative cash flows in year 1, negative in year 2, negative in year 3 forever. Just let it go. The business model is just broken. But let's do a variant, which is a little more interesting. Let's say you sit down to value a company. You do your cash flows in year 1, and it's a big negative number. You do your cash flows in year 2, it's a negative number, but it's slightly smaller. Year 3, it gets smaller, and over time, it switches signs. You say, what kind of company would have characteristics like it? What kinds of companies are you going to see that on? Amazon, not now, but Amazon 97. Young companies will tend to have those because you're building up a business model, you're scaling up. And here's the bottom line. Those companies can still be worth a lot if you get disproportionately large positive cash flows in the future. You know why they have to be disproportionately large? You lose $1 billion in year 1, you got to make 10 billion in year 10 to make up for it. We're going to value a few young growth companies. We're going to value Uber, maybe Airbnb, maybe Zomato. With every one of those companies, guess what you're going to see as cash flows? Negative, negative, negative. It's a feature, it's called cash burn. People wring their hands about, oh my God, there's cash burn. It's a feature with young companies. It's not a bug. And those companies can still be worth a lot. Now, of course, this is what we started the class with. Remember, you can take cash flows to equity and discount the cost of equity. You get the value of equity. Or you can take cash flows to the firm and discount them back at the cost of capital to value the entire firm. So equity valuation, you're focused entirely on equity investors, what they get out of the company and what they require as a return. Still lots of details to fill in, right? How do we estimate the cost of equity? How do we come up with it? But generically, that's what you're trying to do. Alternatively, you can take the entire business. Look at the cash flows you get collectively and discount the collective cash flow you're valuing the entire business. In fact, let me pause there. Can you have a valuable business where equity is worth nothing or less? Think about it. And you live in a valuable house where your equity is dead and gone. Yeah? Let's say you bought this house and the price was $1.5 million. You borrowed 1.2 million. Let's say housing prices have dropped and this house is now worth only 900,000. The house is valuable, right? But your equity is worth less than nothing because you still owe $1.2 million. You can have equity be worthless in a valuable business because you borrowed a ton of money. So I want you to think about the two, because often you'll hear people saying, what's the most valuable company in the world? And what do we tend to think of? Market cap. What does market cap measure? Just the value of equity. Right now, market cap and total value tend to go together because many of the largest companies tend to be huge companies with very little debt. I remember 20 years ago, you know, GE was the third largest market cap company, but because it had a significant amount of debt, it was the most valuable company if you counted the two together. So I want you to start differentiating between valuing equity and valuing the business, because if you do it right, and this is, I think, the key, you will get the same value for the equity. Whether you value the equity directly by taking cash flows to equity and discounting at the cost of equity, or valuing the business and subtracting our debt. So next class, when we start, we're going to talk about the mechanics of how do you get to the value of equity when you value the business, and why the answer is going to converge. Okay.